Top three things in my notebook this morning: Euro bulls, which is our Q4 global macro theme, gold, number 2, and the 10-year bond yield, number 3. Just to go through Euro bulls, number 1, this is a great spot to be getting along the euro and the pound. We like both of those currencies. We also like selective European stock markets. Now, again, the reason why you do this, of course, is because the dollar is a medium-term trade overbought within the context of two catalysts. One, of course, is that the Fed will not taper at the December meeting, and the second one, of course, is the ECB meets later this week, and we do not think that they will tip their hand on cutting interest rates, which was some kind of a peculiar rumoring or hope that the socialists of the world were looking for last week, because they, of course, think that down inflation is a bad thing, maybe for their political lives, but certainly not for the people of this free world, and that is why we are bullish of the euro and European stocks in general. Second thing, gold. I mean, look at this. It's been over a year. It's been actually 165 days that we've had a 0%, much like the Bernanke kind of a thing, but different, 0% asset allocation to commodities for 165 days. That changes today in the Hedgeye model because we're buying gold. Buying it Friday was the first signal in real-time alerts, and we'd be adding to that on the heels of Mr. Bullard's centrally planned, whatever that was, cockamamie talk on CNBC this morning, so that's your catalyst there. And then finally, on the 10-year bond yield, look at this. I mean, we're going to go right up to the trend line, which is now 2.63%, and fail there, ahead of a couple catalysts. I already talked about two in terms of the ECB and the whispering about no tapering at the December meeting. But don't forget that on Thursday, the GDP number is going to come out for the third quarter. There is a pretty good chance that that slows sequentially. So again, if you devalue the dollar and you let interest rates fall, you will start to basically bake slower growth into the cake of the U.S. economy. And again, that's just how our model works. I know that 95% of people on television don't agree with that, and that's precisely why it worked this year. So stay with that.